All right, let's connect with Pankaj Pandey as well, who's joining in, head research at ICICIdirect.com. Pankaj, so much to chat about, but why don't we first up start by getting your take as to what transpired yesterday in terms of those IT stocks. Infosys clearly bore the brunt of the sell-off reacting to its numbers, and you did see that ripple effect out on all of the other tech majors. Your view on, given the kind of weightage and impact it had on yesterday's Nifty fall?
So one thing is, US market is still sort of facing a lot of challenges, especially from a growth perspective. And BFSI being the largest vertical for most of your IT firms will continue to sort of face that kind of a volatility, especially related to growth. Infosys, particularly, we have downgraded or we have lowered our target to 1600. Now it is trading at about 20% kind of a valuation discount to TCS, largely because the growth differential between the two has sort of spiked up. Our sense is that probably 3 to 6 months down the line, as and when the US growth sort of stabilizes and most of the challenges are behind us, probably if we could sort of improve their guidance going forward, that is what we have since, or that is what we have historically seen also. So from that perspective, I think in next 6 months, besides this kind of a price correction, I think we expect IT to sort of do more of a time correction. But these are good levels to buy, and which is why we have a buy rating on both Infosys and TCS. But near-term price performance, I think we don't expect. So things continue to remain sort of lackluster for IT as an overall pack.
Why is ITC making new highs, Pankaj? 1 year ago, nobody liked it. 2 years ago, everybody disregarded it. FIs are selling and ITC is going higher. They're still in the same business, cigarette, FMCG, agri. They were in the business 2 years ago. Nothing has changed, but the stock has gone from 200 to 400. क्या बदला है भाई?
So Nikunj, on ITC, what we are, our target is about 450. Now, when you sort of look at last 5 years, the taxation has been pretty stable. And that has sort of revived the cigarette volume. So even for this particular quarter, we're expecting cigarette volumes to grow at about 13%. And even the FMCG business is expected to grow in double digits, largely led by food, discretionary and stationery segment. And then hotel as a business is already sort of doing well. So we are expecting good set of numbers for most of the hotel players. Now this stock is trading at about 25, 26 times. When you sort of look at the other FMCG majors, be it HUL or be it Nestle, all of them are trading somewhere in the range of 55 to 60 kind of a forward 2-year multiple, which is quite high. And so from that perspective, I think ITC is sort of relatively benefiting. I think high value or high P multiple names are not really sort of facing the kind of buying, largely because there are a lot of fear in terms of entry of new players, be it FMCG, be it paints. Because once you see entry of new players coming in, either the growth gets chipped off or the valuation or the margin sort of get capped, or it could be a combination of both. ITC, I think from that perspective, is relatively better off with valuation being the biggest favor in their favor. So which is why it is helping. And yeah, for ITC, our target price is 450.
This is the right way of looking at ITC valuations. You can't compare with Nestle. The return ratios are different. Their FMCG business is still losing money, or is just about to make money. What is the right valuation for ITC?
So typically, So typically, when you sort of look at cigarette business, see structurally that growth could be about 4-5% in the cigarette business if the taxation were to sort of normalize, or we don't see fresh bouts of higher taxation. Now, FMCG is something which is valued at 4 to 5 times sales. Typically, all these bigger companies or well-established names are commanding even more higher multiples. And then I think the hotel as a business is something where the bulk of the capital allocation has gone in. And that is where I think has been the biggest pain point. But that business is sort of thriving or reviving for most of the players, including ITC. So I think a combination of all these is sort of helping ITC and leading to better valuations or leading to better price performance compared to the other FMCG companies.
Right, okay, that's the take coming in on ITC. A lot of other stocks as well, which have been in focus. And Pankaj, I mean, it's unfortunate that we're only going to react on next Monday, but Reliance and ICICI Bank, one on Friday and then one on Saturday. What do you anticipate from these two heavyweights in terms of earnings?
So Reliance, overall, our sense is that oil to chemical business would see about 11% kind of a quarter-on-quarter growth last year because the refining margins have been relatively better compared to last quarter, while the petchem business is expected to remain soft. Nothing much is expected on the geo side because ARPUs are likely to be at stable or 0.5% kind of an improvement is what you would see. I think the retail business is expected to deliver 20% kind of a growth and with better margins. So our sense is that you will see margins improving by about 70 bips. So overall, Reliance looks a lot better given the fact that they are sort of playing their cards very well in a number of other business segments. I can't comment on ICCI because I'm part of that same group. So, but within bank, I will like HDFC Bank the most.
Right, okay. That's the take coming in. HDFC Bank, clearly the preferred one as opposed to ICICI Bank.
Pankaj, in last 1 year, why a stock like HUL or a Britannia, companies where stocks are expensive, these are FI dominated stocks, these are stocks where margins have been under pressure, they've managed to handsomely beat the market. That's HUL for you, 52-week change, 20%. Britannia, 30%. Now the classic wisdom say that expensive stocks should underperform, and they've underperformed. But these are two stocks which are standing tall.
So Nikunj, a couple of things. Last 1 year, we have seen huge amount of volatility related to market outlook and direction. And typically, whenever that happens, you see defensive sort of playing out better. IT couldn't participate last year because of the global uncertainty, which is still sort of persisting. But domestic driven sectors, especially like, for example, FMCG did well. And it's wrong to say that HUL has not witnessed good margins. I mean, margin used to be about 14, 15 odd percent a decade back, and now these are about 22% kind of a margin. Even for this particular quarter, we are expecting about overall 13% kind of a growth, largely driven by pricing. While the rural growth has been sort of weakish, but overall, FMCG has definitely benefited from this overall uncertainty prevailing in the market, especially in the last 1 year. But structurally, we are not very positive on this entire sector. Like I highlighted, if you're seeing entry of new players, typically these margins, which has expanded by 800 to 900 bips in last 1 decade, probably things might, you might witness more of a time correction rather than price correction in a stock like HUL. And same is the case with the higher price names. I mean, we have seen a company like Colgate not doing anything because it's fairly operating in a penetrated category and with multiple sort of shrinking to about 40 times or even below. So it has benefited last 1 year, but whether that thing will continue to play out, I have serious doubts on it. And typically, we are not holding most of the high price names in whatever recommendations which we have been giving to clients on individual basis or on a portfolio basis. So some of the names which we are liking is one of them is Kajaria with a target price of 1310. One is we expect the gas prices to be softer. See, the margin profile for this company had come down to about 12 odd percent. Typically, the margin profile is in the range of 14 to 16 odd percent. We would expect those margin profile to sort of get attained in FY24. And on top of it, we are expecting about good lower double digit kind of growth in volumes. So that is one stock which we feel that the margin recovery would be the key theme to sort of watch out for. Another stock is Mayur Uniquotors. Why we like this stock is that the management is very confident of growing from say 800 crore kind of a turnover to 1,000 odd crore next year and probably 1,100, 1,200 crore year after. It's a play on the leather segment, especially used in autos, where they derive 55% of the revenues, and the balance is coming from the footwear as a segment. So this is another company which we have been liking with a target price of 5. And then we like some of the names like say the hospitals also, because hospitals, when you sort of look at the deals which is happening, those are happening at 10 times EV by EBITDA, whereas a company like Shalby with a target price of 180, which is what we have put in, is trading at about 10 times EV/EBITDA, and they are sort of venturing into other specialties also besides the knee, where they have got about 15% kind of a market share. And typically, hospital as a space is looking structurally a lot more positive. So this is another company which we have been liking. And then we also like some of the infra names because our sense is that since we are sort of heading into election year, probably we might see elevated levels of spending. So the road players like HEG Infra or something like infra companies like NCC or PSP look attractive to us besides some of the cement companies.
A lot of names, lot of names. One name in the mid-cap space where someone says, I've got appetite to only buy one stock.
So that will be Mayur Uniquoters.
And if it is two?
Then it will be Kajaria, I'll sort of add to it.
Okay, Kajaria and Mayur Uniquoters. Mayur Uniquoters, I mean, just to introduce this one to our viewers, it's an auto ancillary company. And the more cars will sell, the more car seats will sell. And the more car seats will sell, the more it will really benefit a company like Mayur Uniquoter. But Pankaj, in the past, there have been this family dispute issues for Mayur Uniquoter, right? Son versus father, father
Correct.
versus son. Or is that all behind? I mean, I don't track this one actively. I'm just jogging my memory here.
Yes, I think all that promoter-led selling is behind us. That is what the confidence which we have got from the company. And so besides the improvement, what you see in the domestic autos and also the leather as a segment, I think there are 15% of the revenues is expected to come from global OEMs. And that is one segment which is a high margin segment for them. And that is one segment which can grow 2x, 3x over the next 2-3 years. So I think a combination of all this is making us very bullish on the stock.
Move on. And Pankaj, thank you so much for taking time out and joining in. Let's run you